This is Patrick MontesDeOca with the Equity Management Academy live trading room directly from Discord. We want to welcome to all new members that are joining us here. I would suggest for you to watch what we do for a little bit before you start trading real live. If you do, I would suggest to do the simultaneous, the simulated platform first until you get a feel for what we're doing here. Let's jump right into the market here with gold trading last at 1902.40. It's up $4 here. We've seen a major reversal here from the low that we saw of 1884 on the Globex session for the gold market, 27.48 for silver. We have reverted back above 1900 on the news. I believe that inflation was at about 3.2% year to date, a lot higher than expected. So we're getting a lot of inflationary fears into the market again. We did get the reversion that we expected, and we covered our short positions this morning. We recommended our traders to cover the short positions to get rid of the dust, hedge, hold on to your cold spreads until at least we come into next week and we begin the month of June a little more decisively in terms of where the market wants to go. For the time being, hold on to your long positions, your core long positions, and let's see what the market brings us for today. But we've seen a major buy-in reversal taking place from the accumulation area that is recommended by the AI, that every time we come down into this level in blue of buy one and buy two, it's pretty much an area where you want to accumulate, and that's pretty much what happened here earlier. And we reverted back real in fast market conditions and met the targets that you see here of the mean, and we have activated now basically a bullish price momentum with a target of 1907 to 1914 for the rest of the day. The silver market pretty much did the same action here overnight. The market coming down into this area of accumulation of supply, and we found buyers, and the market reverted right above the buy one level, activated a trigger, completed the initial target that we have of 27.84, and so the next target that we have here is 28.10 to 28.26 for the rest of the day. Let's watch the volatility of the market here a little bit, allow for the market to trade here, and I will be keeping you posted here. So let's just watch the market here for a little bit. The coin market is trading at 241.40, down about 537, down about 2%, 2.25%. And once again, I point out to the volatility that the Coinbase or coin market has, or the Bitcoin or GBTC, which are the instruments, the ETFs that we are trading, which are related to Bitcoin. coin is Coinbase. It's the new IPO that came out, and we are trading it very, very actively. It is a very volatile instrument, so you want to make note of that when you are trading these markets. You can see the gold market has entered into the sell one level of 1898, 99, 1907. 1907 is the daily target, but we've completed once again the 1902, which is the weekly target. We've come off that level here a couple of times actually this week. And as you can see here, the weekly settlement level of 1902 has been completed again as we end this week, as we finish this week. Now, you wanna manage this trade up here cautiously. Even though we got this bullish news about inflation and the sentiment out there is extremely bullish, I want to be cautious here because we are entering into what it's called a potentially high probability area of distribution of supply. When you're entering into the red zone, you're entering into what is called distribution of supply, where you can expect supply to come in or sellers to come into the market. As you can see here, the target was completed, and this is where you take your profits on the long side if you came in long, and you wait for the close below here, which has activated a short trigger on this close at 6:45 a.m. It has tested this level here, and now a close below 1902 is going to activate a short trigger once again. So let's watch the market as it trades into this level here for the next few minutes here as it's trying to define pretty much a very critical area of resistance or sellers. And we want to see the kind of buying power that we have here, enough that it could take out all of this supply up here. And that's pretty much what we're looking for. If in fact that is the case, then we got the rally up all the way to about 1931, which is the 61.8% retracement target that we're looking for. I believe we saw a lot of short covering as we came into this morning with a low of 1884. The buy 2 level was expecting a trigger point to be developed at about 1883 if activated, but it found buyers at a higher level here. And It reverted. When it closed here, basically, this was the buy trigger at 1894 at 5:30 a.m. The target is completed. The initial target and also the weekly target. The first target was the average of 1899 from 1894, and the second target was obviously the weekly of 1902. So that was a nice trade opportunity that it gave you, and now it's entering into the sell mode of the weekly signal, and we want to see again, without jumping into, you might say, the gun, what the market does up here, because this is a pretty strong buying that took place down here. It could be in strong hands. So let's just watch the market a little bit here and let the market define for us. It feels like there is a pretty strong sentiment underneath the market that's building up. I believe to a boiling point that is being validated by these economic numbers that are coming out that indicate that inflation is a lot higher than expected. And coming out of this pandemic that we had, you know, in the last 12 months at least, people are dying to get back to some kind of normality. They're dying to go to the movies, to go to dinner, and there is a substantial amount of pent up demand that I believe is being represented by this inflationary levels that seem to indicate really that we are in a supply situation. The pandemic really caused a lot of damage that we're beginning to see now, even with regards to inventories. Not only labor, problems in producing goods, but now the pipeline seems to be dry and demand seems to be well above the pipeline supplies, and we're getting a squeeze in prices, and it's a question of whether this inflationary squeeze is a permanent reflection in prices or simply a short-term aberration, as the Feds are saying. And this is the reason why they don't include energy and food prices, in their calculations of the CPI. But the even without this formulas indicating the level of inflation, the real level of inflation, the formulas that are being used by the Feds indicate still a much higher level of inflation anyway. It's at about 4.2%. And so I believe that the Feds are in a bind with regards to interest rates once again. And the whole world is watching to see how fast this acceleration of inflation on a global basis takes place, and whether it's entering permanently into the economic fabric, you might say, of the system that we seem to be moving into after the pandemic. Is it going to be a highly inflationary environment with price inflation reflecting in short supplies. I think what appears to be the case, there's no question that there is um, stronger demand than anticipated, and I think the key question here is once again the velocity of money um, coming out into the system that is going to make the difference in this inflationary environment. As far as the stimulus is concerned, the Feds continue to indicate that they will continue to print as needed, as much money as necessary, and so that's not going to end anytime soon. But I think the key element in terms of identifying this new inflationary black swan that is developing here is the velocity of money. How fast are we going to go back into the economy and create velocity of money, which is really demand. It's just people buying, hoarding and buying things that might be in short supply. I.e. example, toilet paper. The difference is that now that short supply is being reflected in computer chips, plastics, lumber, essentials for construction, which is really what's causing this massive explosive move in real estate. So, cheap money really has caused now this tremendous new cycle that is essentially a completely debt economy. When you can borrow literally at zero interest rates and you can invest that money in the stock market, you don't need, you don't have literally any risk because you got the government underneath to protect you. So it's free money, basically. And the people that are in a position to take advantage of it are doing it. And we're seeing, all these trillionaires now being born in the last, 50 years, which is really, I believe, a consequence of this huge mistake that was made by Nixon to take the dollar off the gold standard and go and went into basically a completely fiat currency that was essentially that became basically the petrodollar. So we're dealing with the consequences of an inflated debt structure that is unsustainable on the face of interest rates negative. So interest rates cannot go up under this mountain of debt. It's impossible. It can't go up without destroying the world economy. And so the way I believe that things are unfolding here is pretty much by allowing inflation to run a bit, you might say, wild in the short end of the market, in the short end of the yield curve, which is what we're seeing right now, with the 10-year bond as an indicator. We already have seen that go up to about 177 almost. So we're moving into a new value line, I believe, based on what the U.S. dollar represents, what the U.S. dollar is doing regarding our monetary policies and fiscal policies, basically, which is another story altogether, to be honest, which is, one of the things that I try not to do here is try to solve the problems, you might say, of this of these guys that really I believe have no control over these markets here. I believe the Feds have lost control on interest rates, and my concern is if we get the market to force interest rates up, that is going to be you might say, unconsequential conditions here that may develop in the market. If we get pressure by the market to raise interest rates, the Feds have no control. The only thing they can do is they can cap the 30-year bond and possibly allow, once again, to the short end of the market to run inflation, where it's going to go. And for that, I believe they need to cap the 30-year bond, which is another issue. And that's pretty much, I think, where we're moving into, because they're running, out of options that if we do run into this inflationary environment that seems to be unfolding, particularly if it runs out of control, it's going to be pretty negative for the U.S. dollar. And again, the government may be forced, or governments, you might say, around the world may be forced to start tapering interest rates. So, in the meantime, we're running this heated inflation levels that we want to see where they go as we move into the summertime, basically. But if it does continue to put pressure in the market, it's going to put pressure for interest rates to rise. And then we're looking at a potential chaos developing in the swap markets, in the credit markets, repo markets, and it's another potential crisis that essentially is putting, again, the gold market in a position that it's never been before. And, with that in mind, I would say to you that, to me, it doesn't take much to say that it will go back to being reflected as a currency of last resort, which it always has been and it always will during times of economic chaos and monetary crisis. We've seen that for thousands of years. The difference is that I believe we're running into a real interesting change in paradigm, so to speak, that we have developed a virtual market, virtual economy, a virtual currency, as we begin to recalibrate, adjust, you might say, the old physical economy, which has fallen apart completely. So we're in the process of adjusting. We're in the process of resetting the economy. And a lot of volatility is definitely in the works. And there is no market better than the Bitcoin market to indicate the tremendous increase in volatility, which I believe is setting up the benchmark for the rest of the markets as we move and unfold into the rest of the year. This is going to be a very exciting year, a lot of volatility, a lot of trading opportunities. So it's important that you measure pretty much the risk that it offers up here, or in trading this volatility, you adjust that according to your profile. We're trading above the average price of 18.99, so therefore it has activated a bullish price momentum for the gold market. The silver market as well has activated a bullish price momentum by trading above the average of 27.84. And we're looking at a target of 28.10 to 28.26. For the gold market, the targets are 1907 to 1914. Continue to hold your position here, your long position, and I will keep you updated here for the rest of the day as we go along. In the meantime, have yourself a great trading day, and we'll talk to you soon.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit EMA2trade.com for more details.